are for today. How's everybody doing? Hope you're doing well. Relatively quiet, up 22 points. Let's take a look at the market today. And I think today I will just focus a little bit on two strategies that, real quick here today, two strategies that I like when the volatility is in the lower end of the range. So calendars and double diagonals. So we'll talk about that a little bit today. Again, we just finished our first week of our 3-week class in our calendar boot camp, which has been a good class. Some of you are already in it. Hopefully you're enjoying it. Anybody in the current class? Are you enjoying it? Yes, no. The current class. I just want to encourage others, if you're not in the calendar boot camp, we still have 2 weeks left and everything is recorded so you can easily catch up and watch at your discretion. I want to invite you to come in. It'll be Tuesday. Would be the next class. You could check that out on SheridanMentoring.com. So as we talk about the market, you can see we're in a range. We're still in this range over the last couple weeks. And that's what we want for income trades like calendars and butterflies and that type of stuff, iron condors, range-bound trades. And the VIX today, as the SPX is at 3174, the VIX is 2761, which over the last 3 months, the range has been roughly 2425 on the low end, and on the upper end, 40. So in the lower end of the range. So a couple of the strategies I'm looking at today would be a calendar. They would benefit if the volatility went up. And a double diagonal. This is a kind of an iron condor alternative when the volatilities are on the lower end of the range. This is very similar to an iron condor. So I'll look real quick at a calendar and then we'll get into a double diagonal. Looking at let's start out with a calendar. And here would be an example of one I would consider. July 24th is in 14 days from now. July 24th is in 14 days. Matter of fact, July 24th would be 2 weeks from today, right? 2 weeks from today is July 24th. So let's take a peek here at a calendar. At the calendar. And the at the money would be 3175. But again, at the money, when you're talking on a $3,100 vehicle like SPX, 20 points up or down, it doesn't really matter, right? It's a $3,100 vehicle. But I'll put it, since we're up 22 points, I'll put it at 31. I'll just go at the money, 75. And so this would be the type of calendar I might put for today. I'm buying one, July 27, 3175 call. And I'm selling one, July 24, 3175 call. And it's going for $3.80, this particular trade. It'd be $380. You could see the underlying, you know, I have this already, and this is fine. I kind of, once it gets Friday afternoon, I'm running Friday's date anyway, or Monday's date anyways. So We're at 31.74 right now. I'm putting my calendar at the 31.75 strike. And my expiration break-evens were this is my graph in 14 days. This is my graph, well, on Monday's date. That's why it's above zero. So this is the graph in 15 days. And you can see where the expiration, where the profit line crosses zero. We call these the expiration break-evens. On this trade, you get about, in a historically high volatility environment that we're in with VIX at 2763, even though over the last 3 months it's been low, historically it's a high number. In a high volatility environment, you get many more, that's good English, many more points for your expiration break-evens. In other words, we're around 31.75. I've got about 60 points up and 60 points down, all in that area. I do okay in the next 2 weeks. Now, with that being said, how does a calendar make money? A calendar makes money because my short option, which expires July 24, is going to decay a lot quicker than my long option, July 27. You say, Dan, if I only pay let's say $3.80 for this, that's $380. On a $380 investment, if we close right at the strike of 31.75 in 15 days, Dan, is this right? I can make $1,500. That's crazy. No, that can happen. Is it probable? No. You know, is that a tough pick to say we're going to close at 31.75 in 2 weeks? Good luck with that one, right? But the reason you would make that money is your long option would still hold quite a bit of value, but your short option, if we closed right at the strike of 31.75, would go to zero. So this $3.80 calendar, if we closed at the expiring strike of 31.75, this would close at like the spread would be trading for at expiration maybe, maybe $18, $17, right? So right now it's around $4. It would close at $17. We'd make about $1,300, $1,400, $1,500. But again, we don't trade it like that. I'm just explaining how these things make money. I'll hold off on some of your questions until I finish with calendar, and then we'll go from there. So this is a calendar. I think these have been very profitable over the last 2 months. Couple reasons. Because we've been in a nice range-bound market over the last 2 months, and with calendars in a high volatility environment, you get a lot of room on these things. So these have worked out real well. I think they'll continue to work out well. Any quick basic questions on this? Petru says, I put this calendar on 2 days ago for the same price and it had a juicy theta, but no profit yet. I don't get it. Yeah, the answer is they've kept up the, Petru made a comment, it had juicy theta. What does that mean? This position says I make $24 a day on theta, right? Can I go to the bank and say, you owe me $24 a day of theoretical theta? No. So what happened is today, they've lowered a little bit of the volatility of your long options, and they kept up the volatility of your short options. And that's just basically demand and supply. Usually over as you go towards the weekend, it'll benefit a calendar, but let's be honest here. Is there anything going on in the world these days? Anybody? Anything going on in the world these days? Number one. Number two, volatilities are on the low end of the range. So, there could be a little bit more buyers of options going into the weekend. That's all. So, anyways, so that's a calendar. And we've been talking a lot about those in the class. And, but, here's a comment. I tell people in the calendar boot camp, but I don't know if they get it, but I tell them it anyways. You're not going to understand calendars intellectually. You're not going to understand to a degree, you will, but you need to do 30 of them the right way, and you'll get a lot better at it, right? It still mystifies me, right? It mystifies me, and it always will, that students think by doing 5 to 10 calendars, they should be making a lot more money than they are, right? It's mystified me 20 years ago. It mystifies me now, right? The only thing I can think of is guys like, if you take Rich, I'm just people I can see here, Rich and Hans and Mark and Viral Dave. I know most of these folk. It's like, I wonder if people think, well, I'm a successful doctor, or I'm a successful scientist, or I'm a successful army guy, or whatever it is. Well, I should be a successful trader. Now, what would I say to that person? You could be. But what's missing? What do people forget? If I asked Mark or Hans or Rich or Viral Dave and say, hey, how long did it take you to be good at what you're doing for your career? Oh, Dan, a long time. Well, then why the heck do you think after 6 calendars, you should be doing them as good as someone who's been doing them for 3 years? And what do they really want to say is, Dan, you don't understand. I'm Mark or Viral Dave. I'm smarter than most people, right? And you know what I say to that? As my Irish grandmother would say, that's a bunch of malarkey, right? I can't tell you how many lawyers and athletes and smart people that came through the doors of the CBOE that 4 or 5 months later walked right out and they ran out of capital. Was it because they were dumb? Of course not. They were probably smarter than 99% of the traders there. Well, what was the problem? They didn't learn the craft correctly, right? Anyways. Question said, why am I 3 days out? In this example, my long is 3 days further out than my short. Why am I doing that? In some instances, we will go 3 days between the long and the short. And when we're at a historically high volatility, even though it's in the low end of the range the last 3 months, I'm comfortable with that sometimes. And another one of the reasons is because the July 27 is going to work better against the July 24th than if I had an option 30 days out. There's not going to be any surprises, right? Brendan says, would I close this by July 20th by the latest? This is a 14-day trade. Generally in a 14-day trade, the most I'll be in it is 2 or 3 trading days. Anyways, so that's that. The other trade I'll talk about, and again, this is a little more complicated. I'm just going to show it to you today. would be a double diagonal, which is kind of an iron condor alternative, kind of looks like an iron condor. But it's something we would do when volatilities are a little bit lower. So this would benefit if option volatilities went up, whereas iron condors benefit when option volatilities go down. So this. So here's a quick example of a double diagonal. And this is a lot to throw at you, but I mean, now let me just set it up. So the foundation of a double diagonal is the same as the foundation of an iron condor. You're selling an out of the money call and put. That's called a short strangle. So you get probabilities in your favor and you get decay. The difference between a double diagonal and an iron condor is an iron condor, your hedges or your long options are in the same month. In a double diagonal, your hedges or your long options are in a further out expiration. And so double diagonals I would do when option volatilities are a little bit in the lower end of the range, and I think they could come up. Iron condors I'll do when the option volatilities are in the higher end of the range, and I think they'll go down. That's it. So I'll start out, I'm going to sell about a 30 delta in the calls and in the puts, 32.55. That's how I start out. And again, this is recorded so you can go back and look at it after, because I just have a few more minutes here. So I'm going to sell a 30 delta in the call, and I'll sell a 30 delta in the put. Again, that's called a I'm selling it out of the money call and put. It's a short strangle. And then I'll buy my call option at an expiration about 7 days further out in the AUG 7 here. Uh, 7 days in the AUG 7. So my short options are in a duration 21 days out, July 31. My long options are 7 days further out in the AUG 7 expiration. I'm selling a 30 delta call and put. That's my short strangle. And my long calls in August 7 will be 20 points further out of the money than my short calls. So that'd be 32.75. And then my out of the money puts, my long puts will be 20 points further out of the money than my short puts. And then when we take a peek at the graph, it looks something like this. So you can see with the market at 31.70, it's kind of got that, this is the expiration graph, kind of wide like this, like an iron condor. So one thing I can do to bring up a little bit more profit in the middle, if I choose to, I can move everything in 10 points. Let me just do that real quick for you. 32.45, 32.65, 30.70, 30.80, 30.60. So if you look here, this is the underlying. I'm selling the 32.45 call, and I'm selling the 30.80 put. So it's kind of got that iron condor feel to it, right? I'm selling an out of the money call. Here's the expiration graph in 21 days. Here's the graph today. The purple line, we'll call that T+0 line, and then over time, that'll morph into the green graph. And the goal on these, again, these are a little more expensive. It's about, in SPX, if you want to do it cheaper, do it in SPY, this would be about a $3,000 trade. So if I pay right now, the debit is, let's say, 920 debit. If I'm trying to make 7% out of this, and maybe take me a week to get it, 7% of the capital of 3,000 would be 210, about $200. So if I paid 920, if I sell it out at 1120 credit, I'd make $200 divided by my capital of about $3,000 of risk. And so I get about a 7% return if I sold it out for 7%. Now, if I have a max loss of 10%, 10% of 3,000 be $300. So if the double diagonal gets to 620 or lower, I get out. And it's a basic plan without getting into adjustments, when you would adjust, how you adjust. But it's kind of the basics of this. Why not make the longs of the diagonals 3 days from the shorts instead of the 7 days? You could do that with double diagonals. I like them maybe 7 days out. You could look at it like that. But anyways, that's a double diagonal. Again, it's an iron at Condor alternative when the volatilities are low. So folks, a little bit to stew on or think about. Keep practicing the craft. Have a plan. Brendan says, I put this on in SPY, cheaper. Yeah, well, you're learning very good after you discuss this in Trader's Lounge. And keep practicing the craft. And we will see you next time. And if you're not in the calendar boot camp, I'd love to see you in there next Tuesday. Thanks, everybody. Have a nice day.